So how do the wealthy or people with a lot of money view whole life insurance, specifically for the cash value benefit? Well, typically they view the cash value as a safe area they can position cash, that they can use like a personal line of credit, and it has a very nice tax benefit. What we're going to look at today is someone who had started a policy back in 2020, so somewhat recently. He's funded the policy for 4 years thus far, 4 policy years. Policy year 5 begins in April of 2024. And he's got a little bit over $2 million in cash value today. So his policy has a lot of money in it. And we'll go through exactly how he looks at the cash value every year when we have review meetings. He has very similar questions. He's looking at the performance in terms of rate, dollars. He's looking at his current tax bracket, and if he were to put money in other assets or different investments, what would they need to produce to get the same equivalent that his life insurance policy is producing? A lot of stuff there with respect to the growth. And then also, he invests in real estate, so he wants to look at models of how he can use the policy for real estate. So we'll go through this, but just to begin with what we've got on the left. Annual funding. First and second year, he funded $1 million per year. So that's when he got $2 million into the policy. Years 3 and 4, he scaled back to just the premium. It's about $100,000. You'll see it's slightly higher than that. And his current plan is to continue to fund the $100,000 until he wants to stop. Now, his original plan back in 2020 was to fund a total of $5 million at $1 million per year for 5 years. So that was his original plan. However, after getting the $1 million in years 1 and 2, life changed a little bit. He still does very well financially. He owns a company that has over 150 employees, I believe. So he's got a large business, does very well, but he had redirected some of his assets elsewhere and said, you know what? I like what I've got in the policy. I can use it as is. What's it look like if I just fund the minimum for a while? So he's done this now, which is $100,000. If he wants to scale back up, he can. So that was his original plan. He planned on funding $1 million per year for 5 years. Did he do that? No. So the initial policy that we submitted to the insurance company displayed this. However, he stopped that after 2 years, and now he's doing this, which demonstrates the fact that you can adjust what you are funding a policy with as time passes. How you set it up is very important. The setup here had a base premium of about 10%, so 100K, and then the rest was directed toward PUAs. That's the other 900K. So we were stuffing the cash value with that policy, which we do with every policy, regardless if it's $1 million or if it's 10,000 per year, it doesn't matter. But here's often what he asks. So we had a review meeting, 2 of them actually last week, and every year when we connect, he's very interested in what we see here in green. What is the growth percentage, particularly the internal rate of return? We're going to look at the yearly growth rate in this example. He's in a high tax bracket. What are the 3 benefits, the 3 core benefits to the cash value of a whole life insurance policy? I want to position money there because it's safe, goes nowhere but up. Number 2, the liquidity. I can use it like a personal line of credit. And 3, the tax benefit. If I do everything right, I can access that cash value tax-free. So when we have this term here, taxably equivalent, what he's looking at here is if I'm earning 4% in my whole life insurance policy, but it's a tax-free yield, what would I have to earn in a taxable asset to net that same 4%? For example, if I feel I can earn 7 or 8%, let's call it 7% over in this other asset class or this investment someone's recommending. If I have to pay taxes on it, after those taxes are paid, what's my net return that I'm left over with? Is it 4%? Is it 5%? And how much risk did I need to take on? That's what he's looking at because he's got money in other assets. He's got other investments. He's heavy into real estate, but he's got other investments as well. He's got his business. He's got a lot going on. So he's looking at this as a safe area to position money and really looking at the growth rate and saying, okay, does it make sense to continue to feed this policy based on what I'm seeing in growth? Or if it's not high enough, even in my current tax bracket, then I'll redirect some of my capital elsewhere, or I'll stop funding the 100K and put that somewhere else for a bit. If I want to resume funding later, I'll do that. Remember, it's flexible so we can stop and go. But you'll see the taxable equivalent. That's what the taxable equivalent is, meaning if I'm earning a return in a taxable account, what am I left over with net after I pay taxes? So we've got the growth in terms of percentages, but then also dollars, which makes things easy, where you can just ask, what did I get from the insurance company this year? Meaning, what do they pay me in total guaranteed interest and dividends I received? Was it 10,000, 100,000? What's the dollar amount? And then the same thing with the total gain, which is very simple. We just looked at how much you've paid into the policy. The term that's used here often is your cost basis. So how much did you pay in? And then how much do you have in cash value? And the difference would be your gain. And then using the money with respect to policy loans, so he's heavily involved in real estate. What he's always asked about is when it comes to policy loans, he wants to see what are the gains on the policy, or how much is he getting from the insurance company compared to how much is he paying them in loan interest. And he does not want to be in a position where he's paying them more in loan interest than what they're giving him. Or he doesn't want to see a huge negative spread there or be in the red for a long time. So we want to model that for him. So let's take a look. We're going to look at his policies here. When I say policies, he's got two policies. Up here, we've got the combined values. And here's the first option. We won't spend much time on this, but the first option displays what things look like if he elects to stop funding altogether after the last payment, or after making a payment in year 5, which the original plan was to fund $1 million per year for 5 years. So what we did put together is an illustration that assumes he still stops funding altogether after 5 years. Remember, he paid $2 million total years 1 and 2, then just over 100K years 3 and 4. So by year 5, if he pays another 100K, that's where the 2.3 comes from. 2 million years 1 and 2, and then 2.1 year 3, 2.2 year 4, 2.3 year 5. So that's the 5-year funding example. Let's look at the example he's interested in, which is funding it until he wants to stop. Let's make this a bit bigger. Sweet. So here's what we've got. On the left, annual outlay. This is what he's paying, and this is just the premium, by the way. No PUAs are being added. He heavily funded the policy in the early years. If he wants to add more PUAs, he can easily do that. So here's just the premium going in. Total funding, or his cost basis, there we go, 2.3 at the end of year 5. Cash value and death benefit. Let me highlight something with the death benefit. What do you notice there? Years 7 to 8. Drops. It's cut in half, more than half. That's optional. We may do that. We may not do it. We'll see what things look like when that time comes. Maybe we'll only partially reduce it. What we're doing here is removing the term insurance rider altogether. So we're cutting the term rider. The earliest we can do that without triggering that MEC, that taxable event, is in year 8. And by cutting that term rider, what happens, and this works if you're only paying the base premium in a case like this, is it boosts the policy performance. You're cutting some of the drag or the expenses. Look at your IRR here, which is the net growth rate that he's receiving each year. So it's at about 2.8%, years 5, 6, and 7. Then what happens in year 8? Jumps up quite a bit to over 4%, and then continues to increase. And this is all based on the present dividend rate with this life insurance company as well. Every year we update this as the dividend changes, and if he's adjusting his dollar amount going into the policy, that's going to change things too. But my point is, when we cut that term rider, that's a lever we can pull on the policy where we don't fund anything different, but our performance increases. And when we're looking at big numbers like this, 7 figures per year, well, does make a difference when we start to look at the amount in dollars. It gets bigger, especially once it starts to pick up the pace and compound. So the annual IRR is just looking at the yearly growth rate. Then we've got the taxable equivalent, presently at a 40% tax rate. So what this is showing here is what he would have to earn in a taxable account, and then after he pays taxes, he'd be left over with what we see on the left. So for example, if we look at, let's look down here, year 10, you're just about at 7%, 6.96%. So if I'm earning 6.96% and I'm in a 40% tax bracket, after I pay taxes on that, I'd be left over with a net of almost 4.2%. That's what that calculator is showing there. And again, none of this is tax or investment advice, all for educational purposes, disclaimer there, but I hope this helps in terms of how people often view this. The tax rate is programmed where we can change that. So for example, if we adjust that percentage there, what you'll see happen is the taxable equivalent will change. See where everything went down? Look at year 10, at 5.96. I'm going to go back to 40%. Look what happened. Came back up. So we do program that where it can be adjusted. Then we've got the cash value growth in dollars, and this is how much you're getting net year over year from the insurance company. And then we've got the total gain. First 2 years of a whole life insurance policy are the worst 2 years. We don't see years 1 and 2 here, but years 1 and 2, that $100,000 base premium did not show up in cash value. However, as he's continued to fund the policy, we see that he is experiencing positive growth each year, and he's just about made whole. Year 5, he's just about there. Year 6, he's positive in this example. And one of these policies does have a standard non-smoker rating. If we're able to upgrade the rating, which is something we've been working on for a while now, we could see it improve quite a bit, which is nice. Because when we upgrade a rating, it does go back to day 1, the policy issue date. But this is the policy performance, the growth. These are the kind of things he likes to look at each year. We do like to update this and review everything year over year because it's money. It's his money. And frankly, he's got a lot of money in it, and it'll continue to grow. How he views it now, the last thing that he had mentioned, was this. Funding it at $100K per year is not that difficult based on my financial situation today. So as long as I can continue to fund it, I will. And what I really like is the fact that this is a safe area to position money. It just continues to compound. And if at 60 to 65 or whenever, I've got $5, $6, or almost $7 million sitting there in cash value that I can access tax-free, that's very appealing to me. It's a nice tax-free bucket of cash, along with a large death benefit that's paid income tax-free as well. So when it comes to using the money, here we go. We've got our loan workbook. A lot of fun here. So what we did was just dropped in his illustration. We can run actual policy loans as well in the illustration software, which we definitely would. But this is meant just to provide a quick ballpark figure of what the numbers will look like. So he's got almost $2 million that he can access right now. Let's assume he has an opportunity and he wants to borrow $1 million against his policy. Well, when he takes that $1 million, in fact, I'm going to do it this April, so that'll be the next policy year. When he takes that $1 million, the current loan interest rate is 5%. What's 5% of $1 million? You'll see it here under blue. Annual interest payment, $50,000. Remember when we said he wants to see what his money is growing by compared to what he is paying the insurance company? This is exactly that right here. So what we've got here, annual interest payment, what he would be paying to the insurance company the first year he takes out that loan. What is his money growing by that year? This way he can isolate exactly what the numbers look like year by year. Well, his gains are about $61,000. So he's positive about $11,000. Now, what if that opportunity was $1.5 million instead of $1 million? Well, let's just plug in the numbers and see what it would look like. 1.5, now all of a sudden, not as favorable. The cost is about $14,000 because the growth, 61, interest payment, 75,000. Now, if the opportunity was worth it, he said, okay, I'm in the red for a year or a couple of years here, but this is going to cash flow quite nicely, and I'll be able to repay this at $10,000 per month. It's $120K per year. Let's pay it back, shall we? What do things look like? Well, now we're paying that loan down. Nice. And as the loan balance shrinks, what else shrinks? The amount of interest you pay annually. See what's going on here? So again, yearly cash value growth compared to the annual interest. You can compare the gains as well, total gains compared to the total interest paid, along with the death benefit. This is the death benefit with the loan outstanding as well. When you see the $1.5 million loan outstanding, that's how much less the death benefit is in that particular year. So where this has really helped him, and we see it help a lot of real estate investors, is I can again see firsthand what is the policy growing by compared to what I'm paying in loan interest. And then also I can see the total loan interest I've paid over time. For example, if I take out a mortgage, I see a certain rate on my mortgage statement, but I know that it's typically front-loaded and I'm paying a lot more interest in the early years. So what a lot of people find helpful, I know I do, is if I can see what's the total amount I'm paying to the bank in interest. I just want to see the total dollar amount. That's the purpose of this column, and what we can do with the policy is look at the total cash value growth as well. So I do hope that this video was helpful. Please let us know your thoughts, and if you have any questions, and as always, I hope this helps. Thank you so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.